The 15th largest bank in the United States just failed, and its collapse has massive implications not only for the markets, but also the Fed's future actions as well. Hey everyone, it's Jonathan here. So let's talk about what happened and the possible effects that this might have to the market and the Fed overall. So the bank that failed is called Silicon Valley Bank. To explain kind of why they failed, we kind of need to explain what banks do and how they operate. So generally speaking, a bank will take your deposit. Let's just say you're depositing $100 into a bank account, and they'll take that money and they'll do a couple different things with it. They'll either lend it out to someone else, or they'll take that money and they'll use it to buy treasuries, or they'll take that money and they'll deposit it with the Federal Reserve. Typically, what a lot of banks tend to do is they tend to put a good majority of the cash that they have on hand in treasuries. Even though treasuries are considered some of the safest investments you can make, the thing about treasuries is that they do have something called interest rate risk. And pretty much what happens is that, let's say you buy a treasury, a 2-year treasury that yields 2% every year. Well, the problem is that, let's say that the Treasury Department is now selling 2-year treasuries that yield 5%. Well, your 2% treasury is going to be a lot less valuable than 5% treasury because it yields a lot less, even though the risk profile is still technically the same. Because of this, a lot of banking institutions and other entities that hold a lot of treasuries have been marking down the value of their treasuries. And typically this isn't a problem as long as you hold your treasury all the way till maturity. But with Silicon Valley Bank, the problem is that they were facing a lot of withdrawals. So they specialize in providing funding to startups. Even from this time last year, we did hear a lot of news about how a lot of VCs are not really making too many investments anymore. So a lot of these startups are looking to pull money from their accounts to be able to fund their business's day-to-day operation. And this influx in withdrawals did cause Silicon Valley Bank to have to be able to sell some of their treasuries to kind of shore up their liquidity. But this was seen as a sign to a lot of venture capital firms as a warning sign that the bank may be illiquid, and they warned a lot of the startups that they work with to pull all of their money out of the bank. And basically this just caused the bank run that they were already suffering to become much worse. And it's believed that the average yield on their treasuries were about 1.9%. And like I said, right now you can get a 2-year treasury for about 5%. So by selling those securities, they took some massive losses. And basically because of that, that's why they became illiquid. And then California regulators had to step in and basically shut down the bank and hand it over to FDIC to allow people who had deposits under $250,000 to be able to have access to those deposits. And I believe that they said that they will start issuing access to those deposits Monday morning. And they did say that if you do have more than $250,000, that you should reach out to FDIC immediately, kind of figure out what the next steps are from there. This was the second biggest bank failure in US history, right behind Washington Mutual, which is really interesting because the first bank count I ever had was at Washington Mutual. And I actually don't really remember them failing because I think at that time I was like 8 or 9 or something like that. This was definitely a massive failure, and it was very unexpected. Mostly because of why I told you, when you look on a lot of banks' balance sheets, they don't have to mark down unrealized losses. They only have to mark down realized losses. So unless if you pay very close attention to their balance sheet, you won't notice that. So that's kind of why the whole market got caught off guard about what was going on at that bank. So now the biggest risk really to the market is contagion. A lot of times when you see banks fail, that usually leads to another bank failing and another bank failing. But given the fact that they were the 15th biggest bank and they weren't much bigger than what they are, most people on Wall Street believe that this is very unlikely that we will have contagion come from this. But we have seen some companies that are negatively affected by what's going on with Silicon Valley Bank. For example, Roku said they had about 26% of their cash and cash equivalents deposited in the bank. And they're not too sure if they'll be able to get their money back or not. So that'll be something that if you are a Roku investor, you probably want to pay attention to. Roblox also had about 5% cash in the bank, but they don't believe that it'll make too much of a material impact to their day-to-day business. Now, the stock market obviously saw this and they started to panic because this brought a lot of memories back about the 2008 financial collapse. And the S&P 500 was down about 1.5% for the day on Friday. But at the same time, we also did see Treasury yields fall, which was mostly backed by the fact that there's strong belief that the Fed may actually have to either slow down or just completely stop hiking rates, given the fact that they've basically have broken something. We've seen two banks fail in a matter of a couple of days away from each other. And there's a lot of belief that the Fed's actions are lagging to what's actually going on in the market. So because of that, the fact that we're now starting to see two banks fail that were basically caused by the Fed's actions are starting to make people believe like, okay, I think the Fed has kind of done more than enough and they need to chill out now. And the market is mostly saying this given the fact that the bond market believes that we have a 60% chance that the Fed will pause hikes at their next FOMC meeting in a couple of weeks. So overall, I think that this bank failure, even though it is very unfortunate for the parties involved, I don't think it's that big of an issue for the market overall, as long as there's no contagion. If there is contagion from this event to other financial institutions, then I think we have a much bigger problem on our hands. When you think about Silicon Valley Bank and Silvergate Bank as well, there's a common theme that both banks are serving a specific client base. With Silvergate, it was crypto, which we have seen crypto go under massive this overall market pain. We've seen the collapse of different firms, firms going bankrupt like FTX and Voyager. So Silvergate served more of just that one subsect, whereas Silicon Valley Bank really catered more to startups. When you look at some of the bigger banks like JP Morgan Chase, Bank of America, you start to notice that they have a much more diversified clientele. So the chances of this happening to a much bigger bank is probably very low. I think that the stock market will just kind of get over it over time. And the market will also realize this as well, that it's not that big of a deal, especially if we have no contagion coming from it. Now, when it comes to the Fed, I think that this basically guarantees the fact that we won't see a 50 basis point hike at the next meeting. If we do get any hike, it'll probably be 25 basis point hike. In my opinion, I feel like that has the greatest chance. I don't think we're going to see a pause, unless if we just get some superb CPI numbers this month. But I think that this does show that the Fed has broken something. And the thing about the Fed and their rate hikes is that a lot of times we don't feel it immediately. It's something that takes some time to brew. And I think that now we're finally starting to get to the tail end of us not feeling the majority of their actions. And that over the next about 3 to 6 months, we're really going to see what the Fed has done over the past year or so. So that's basically all I got for you guys. Thank you so much for watching. As always, please like, share, and subscribe. And I'll see you in the next video. Peace.